All right, folks, welcome to Leading Indicator, a show by Public.com, bringing you the very best insights from the very best macro minds. And joining me here today, Jay Woods, Chief Global Strategist at Freedom Capital Markets here from the New York Stock Exchange. Jay, thank you for being here.
Hey, it's great to be here. Thanks for coming up to the balcony. This is great.
It's a great shot with a great guy for a great conversation. But, of course, let's talk about the Fitch downgrade here of U.S. long-term ratings. People waking up to this news or caught it late last night. Still trying to get a bit of a sense about what this actually means. How big a decision is that from AAA to AA plus from where you're situated?
Well, it was a huge headline. This was something that we thought would happen in 2011, so they're a little late to the party. It's telling me the S&P downgrade was a little more valuable. They put us on watch in May, back during the debt ceiling, so I didn't know we were still on watch after the debt ceiling crisis, but they're concerned about the next 3 years going forward. The debt to GDP ratio is a little above their average, so they downgraded us. The initial reaction was down, but this market has been resilient. This is not moving the needle like I thought it would be. I figured we would get a 1% downside move in the S&P 500. Not there yet. It's early. We'll see where it takes us. We haven't had one in 2 months. Wouldn't it be shocking? This news should have taken us there. Shrugging it off. It's crazy.
I mean, how much do you see the divisions on Capitol Hill, the inability, and then they say not just the current environment, but they look back at the better part of the last 2 decades, and they say you got these gridlocks, these 11th hour standoffs. I mean, how much do you think that factors into the decision? And you follow the news out of Washington. Yeah. I mean, how concerning is this, just to see how evenly split we are?
Well, I'm shocked because one side's blaming the other and the other side's blaming the other. I've never
Finger
seen
pointing?
anything like
Never.
this. No, when it comes to Washington, someone's going to have to throw somebody under the bus and blame it. Janet Yellen came out today and was, disappointed, not her words, but the motherly figure she is. To me, she's disappointed in the downgrade and the timing of the downgrade. But as far as it, kind of makes us react down here, down, but not shocking, considering this is August, September, nothing shocking.
So to the fact of August, September, historically speaking, Jay, you know better than anyone, not usually the strongest performing months for equities. Give me your sense on seasonal headwinds as we now are in the second trading day of August, knowing what's on the horizon for September.
Yeah, August, September, seasonally, as a technician, we follow seasonal patterns, election cycles, all these fun things. August, September, for the last 20 years, have been the worst 2 months of the year consistently. And August has had some big moves, 2011 with the downgrade, so that's why we were a little like, oh, it's August and we're getting a downgrade here today. But August, September, it can be choppy. And given the run that we've had, a pause, not out of the cards, and yes, first 2 days of August have been a little rough. I don't think it's anything to be long-term concerned about, long-term being now to the end of the year, but we could see some more volatility, and that would be nice.
For people who are a bit unfamiliar, why historically is September the worst performing month for the markets?
There's no specific reason as why September is. It's there's no moon cycle that people look into and say, oh well, watch out for September.
Something in retrograde.
No, it's just a random statistic that proves true cyclically over time. Maybe it's everyone getting back and readjusting portfolios, getting ready for the end of the year. But historically, we see a lot of jockeying, positioning, getting ready for October, November, December, and there have been some negative headlines along the way. So that's the stat, and that's what I'm going with.
As a technician, what are the things that you'll be following, you think, as we head into September, keeping in mind all the wild macro stories that you cover, as well as all the things on the charts and the technicals that you follow very closely? What are things that you might want someone watching this to kind of take away that maybe that person's not already considering?
Yeah, well, you talk about seasonal patterns. We know August, September, we just talked about that, but the last quarter of the year is the strongest quarter of the year. The next 6 months, actually, October through March, happen to be the strongest 6 months seasonally every single year. These are just facts. What does it mean it's going to happen? Is the past prologue? Yeah, it is, but it doesn't mean it's guaranteed. But what is happening this year, and why I think we're going to be strong this year cyclically, is a lot of people have to chase performance. There's a lot of people that weren't in those big 7 names that really performed well, those tech stocks, those AI plays, and now they're looking for stocks that have kind of lagged, that are starting to turn a little bit, and may have a run in them to the end of the year. So you're seeing the Russell 2000, the small caps, seeing stocks that were big high flyers in 2021 after the COVID crisis, those IPOs, those SPAC names, starting to catch a bid, and it's exciting. As a technician, if I see something that all of a sudden stops going down, goes sideways, and now is peeking its head, it's got my attention.
All right, other things I'm sure have your attention. Earnings season. Were you aware it's earnings season? I'm sure you were.
Well, it is the busiest week for earnings season this week. It slows down after this. We have some doozies coming up in Amazon and Apple later in the week. We had Merck, Pfizer. The S&P 500 is in the meat, if you will, of earnings season. And I think that's why the Fitch downgrade hasn't really reacted, because we're seeing a lot of companies that lowered their guidance beating that bar. So it's a lowered bar, but we're exceeding it. And then the guidance going forward from stock to stock, it's been relatively strong.
Starbucks is an interesting name to follow in terms of consumer spending. You and I have talked before about some of the potential implications here of student loan kind of resuming come August 1st. Talk to me about that stock and what we saw earlier this week.
Yeah, Starbucks reported earnings, and the guidance was kind of tepid. It was not what we expected out of them. They did beat. They had strong China growth, which was something a lot of people were focused on because of their COVID problems coming out of it. But there are some headwinds for Starbucks. Consumer, the debt for student loans is coming back. And, as a father of 3 students, 2 of them very, conscious about their Starbucks, if those prices continue to be passed on to them, which they have, they've been absorbed so far. So we'll see if that little extra payment that will have to be, subsequently countered by cutting back somewhere affects someone like Starbucks. Technically, it has kind of a head and shoulders top. I wouldn't call it, it's not your textbook, but it's below the 200-day moving average. There are some headwinds, although it is pumpkin spice season coming up, so who knows how they react. That's a strong season for them, too.
We all love PSL. What's your Starbucks order, Jay Woods?
I am a cold brew guy through and through. Just keep it simple.
I like it. Yeah, me as well. Okay, let's talk about Pfizer and Merck. We got those names this week. What have you been following out of those reports?
Yeah, tale of 2 stories there. Pfizer, great dividend play if you're looking for a long-term stock that really doesn't move too much. But the story with Pfizer was they disappointed because of COVID pills, COVID vaccine-related sales. That's a good thing for us. I want this to go away, but that was something where they thought they'd have a little more longevity, and they're trading at 52-week lows. I do not like stocks trading at 52-week lows that disappoint. If you're a long-term investor, maybe this is something you want to kick the tires on, put it away, collect that 4.8% dividend. But to me, Merck is the better story there. Merck is in the midst of a deal to acquire Prometheus. It's a $10 billion deal, so the stock isn't going to really do well until it clears that hurdle. When you're spending $10 billion, it may have an effect on your earnings, but Keytruda was the one drug that did do well in their pipeline. It helped their revenues. It is strong. It's within 12% of its 52-week high. It's only down 5% for the year, where Pfizer's down 30%. So to me, Merck of the 2 is the play. Their pipeline's a little better. They're not reliant on any COVID medication. So if you're going to get in one of those 2 names, I would say Merck.
Finally, let's talk Apple, Amazon later this week. Any other big names? Some of the specifics that you'll be looking for that maybe someone watching could say, hey, I had not thought about that ahead of time. Now I'll be more closely tuned in when we get those reports tomorrow.
Well, first of all, these are 2 of the greatest stocks to have in your portfolio. You just put away. Don't even think about it. For the long-term younger investor, Apple, Amazon should be a core group in your portfolio. But 2 interesting things. Let's go Apple first. Apple is trading at 52-week highs, all-time highs. It's made a tremendous run. Another stock that reported a week ago that was doing the same thing was Microsoft. They had good earnings. It has sold off. So we're seeing those stocks that have done well. If they don't come out with a big AI story or guidance that shocks us, it wouldn't shock me to see the stock retrace a little bit, have some profit taking, come back to its rising 50-day moving average. That's like a 7% drop. Not that big of a deal. Amazon's still got some work to do. It's not even near its 52-week highs. No, not near its all-time highs. I apologize. The stock has been doing well. We're going to hear how the web services division is doing. There has been chatter that maybe they'll break things up, and we'll see if they go that way. And then, of course, AI. Let's see if they talk about the AI story. But Amazon, like Google, are 2 stocks that have kind of lagged the big names. And Google did well after earnings. I expect Amazon to do well as well, although it has traded lower 9 out of its last 11 times after earnings. So I don't like that track record. But overall, 2 stocks I would put away and not even worry about.
And, of course, we'll all be frantically counting how many references to generative AI are on these calls. You always love that statistic. I don't know how much it means, but listen, it's the shiny thing this year. Everyone wants to prove that they've got their slice of the pie to investors. investors, right? They're trying to communicate, hey, we're on the cutting edge of AI, right?
Yeah, no, I've seen AI mentioned in some of these healthcare stock calls. So it is the big thing that everyone wants to know. What is your AI strategy? What is your AI plan? And that's good. If it strikes a chord with investors, you may see a little irrational exuberance and the stocks run a little bit higher.
Finally, earlier this week, you and I were talking about a name like ARK, something I know you have some thoughts on. Talk to me about that before we wrap up for people that know the name, are familiar with it to some degree, and would be curious your thoughts on it.
Yeah, the ARK fund is, Cathie Wood. Everyone knows Cathie Wood. It's one of those stocks, like I mentioned in the Russell. Stocks, a basket of stocks of companies that have been beaten down 75, 80% off of their all-time highs that have finally stopped going down, started to go sideways, and are trending out. And then if you look what's in it, we've seen runs in Palantir and Coinbase, Roku, and now there are other stocks starting to lift their head. There was another stock, which I don't think is in the fund, but Match.com, another stock that had been beaten down. It really ran during the pandemic. Strong earnings, gap above, and it's got a lot to reverse. So these are the stocks I look at, and ARK has a whole group of those within its fund, so I continue to like ARK. I've liked it for the last 2 months.
There's no doubt you have made our viewers smarter today with your analysis, and I'm very grateful for your time joining us here on Lead and Indicator. That's the great Jay Woods. Jay, thank you.
Yeah, thank you for having me. Always great to talk to you, JD.
All right.